All right, guys. The market is up big this year. The NASDAQ 100 is up like 45% so far this year. It's crazy. It's insane. So what does that mean? So guys, I'm on Twitter. I'm very active. As you can see, 1,400 tweets just in the last year. Follow me there. I like to get very active discussing economics, stocks, etc. I engage. I really enjoy that platform. And now it's been changed to X. Kind of weird. I'm not going to zeet. I'm going to tweet.
That's what... Wait, what?
Isn't that what they're calling it now? They're calling it zeeting.
I didn't know about this.
X-E-E-T. Yeah.
That's pretty cool.
So they're doing that. So yeah, follow me on there. I really like to engage about stocks, and I talk about quotes. I do a lot of other things. So with this recent run-up, let's pull up QQQ right here, because this is the NASDAQ, year-to-date, 42.78. I mean, guys, is there a crash coming? I have no idea. Nobody has an idea. Anybody who claims that is just absolutely BSing, and they might be right once every so often, but it's not a consistent thing. But let me say something here. The further and further and the faster you go up, the worse it's going to be. I mean, look at our overvaluation levels. Mo, do you check on our software when I talk about the overvaluation? We're 83%.
83%. I just checked this right before we started.
You're 83% is a stock market overvalued based on the stock market to GDP ratio.
And the funny thing about that is not just that it's 83%, that it was just in the 60s.
It got to 59%.
A couple of weeks ago.
No, it wasn't that low. A couple you mean 60s, yeah. High 60s and 70.
I was like, oh my gosh, how has that gone up so quickly?
The low was like 59 or 58 back in October. But guys, for those of you who still don't believe the stock market GDP ratio is reliable anymore, fine. Let's base it on the 10-year PE ratio. Guess what? That's more overvalued. It's 86% overvalued. And that takes all the earnings of the last 10 years, brings them to today in today's dollars, and divides them stock market by that. The stock market total market cap by it. So when was it in the 60s? It was May 31st. May 31st. It was below 70%.
Yeah.
So guys, euphoria is rampant. We have a lot of excitement. The AI boom has really caused a lot of things to really skyrocket. Remember, the Magnificent Seven, as our friend Jim Cramer called it, are the 7 stocks that are really driving the NASDAQ and driving all of these returns. Because look at SPY. So the NASDAQ is up 42%. The QQQ is up 42% this year. SPY is up 19.38. That doesn't include dividends. So I look at that saying, boy, it's been really driven. And then there's a lot of data. I'm sure now the overall S&P is up more than zero, but at one point the S&P was up 11 or 12%. But that was all made up by the top 7 or 8 stocks, and the rest of the S&P was 0%. Go ahead.
Here they are: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. Those are your 7.
Those were driving all the returns.
Yeah.
Now the S&P is still up. So guys, when you have, this is the same thing that happened in 2000. I remember always hearing people talk about 2000, and we always joked and said it was a lot of the top stocks really driving all those returns. Boy, we have that again. So are things going to correct? Well, eventually we'll revert back to a mean. The mean will happen. The 10-year cyclically adjusted PE ratio, the average is about 17. We're at 31.4 or something. And the stock market GDP ratio that I created based on the S&P and S&P equivalents going back to 1929, the average is 0.933 or 1.7 or so. So we're going to have to revert back to the mean at some point.
Yeah.
Now, maybe the mean goes a little bit higher, but it's not going from 0.933 to 1.5.
Right.
It might go to 0.95, maybe 1, but it's not going to deviate that much. There's too much stock market history. Even if you go look at only the last 25 years, which were mostly overvalued, it's still way above average. So whenever the pendulum swings, this is what we talk a lot about in terms of investing. The pendulum swings from side to side. The further on one side it goes, the further on the other side it swings back, right? If it only goes to here, probably only goes about here. The further and further the swings. Look at 1982. At one point, so we're at 1.7 on the stock market GDP ratio. Back in 1982, it was like 0.4 or 0.35. Yeah. That was one extreme on nobody believed in stocks. In fact, Barron's had an article in which did a cover of Barron's in 1982, right before the big run-up started, the death of equities. Mm-hmm. Like, nobody just likes stocks anymore. These are terrible. You can't get returns from them, because they were coming off of 16 years of no growth whatsoever.
And it's funny, we wouldn't have to worry about these extreme lows if we didn't just go to these extreme highs. If we just stayed in those 2 ovals that you just circled here and here, just let a recession happen. We hear recession now, and it's like the worst thing in the world. like the world's going to end.
Well, the IMF just came
really-
out today and said that everything's looking good for the world economy, which could be the case. But remember, we have an inverted yield curve that we've had for over a year now.
Yep.
An
July
inverted yield
6th.
curve is a 2-year treasury is giving a higher rate of return than the 10-year treasury. It should be the other way around, because the longer and longer you give money to somebody, the higher the rate you should charge, because you're taking on more risk of things happening down the road. But now people are perceiving that the 2-year number, the 2-year risk is higher than the 10-year risk. The 2-year treasury right now, Mo, is about 4.9, and the 10-year is 3.9, about a 1% spread.
That's huge.
That's a big
huge,
spread.
Especially for over a year. July 6th was when they inverted for the first time, and they haven't reverted.
July 6, 2022.
2022, yeah.
Yeah.
My bad.
That's a pretty big difference. Now, when you get to these extremes of valuation, it's more likely that there's a crash. But remember, guys, that's why we're here on this channel. That's why we want you to follow us, because when things are bad, it's the opportunity of the astute investor. It's the opportunity of somebody who says, listen, the stock market isn't going away. Figure out a way that if stocks were to fall 50% from today, how do you buy more of them? How are you able to buy more? Because at that point, both major metrics would be undervalued if stocks fell 50% in the next 2 months, hypothetically, which I'm not saying will happen. It probably won't happen.
Mm-hmm.
I mean, even during COVID, it took a month for a 40% drop and rebounded right back up.
Right.
But what's probably more likely to happen is we're going to have some quick drops, a little bit of rebounds, quick drops, and more of a sideways movement over time. If you look at the decades, the 16 years, let's look at SPY. And let's look at the chart.
And that's kind of what you saw going. You had your peak here in November of 2021, and then it fell off hard and rebounded and fell off hard and rebounded, and now we're just rebounding. But that's what should happen, is a fall and then a rebound, and a fall and a rebound, not just a straight drop.
Right. And a lot of people are calling this the echo boom, which I think is a great term because it makes everybody say, by the way, during 1966 to 1982, during that sideways market where the S&P went from 110 to 110, they still had new highs of 140 where they hit new highs all the time, several times during that time. But guess what? It was still sideways movement. Why? Because overvaluation drove it. Look at 2000 to 2000. Let's look at 2000 to 2010. SPY hit a high of like 153, and you have to go to, in 2013, it was still at 153. It was 13 years of basically no growth. That's incredible. Why? Overvaluation. 13 years of no growth. Does that mean you couldn't make money along the way? Of course you can make money along the way. If you kept buying all the way down and dollar cost average, that's the hard part about investing. Is staying there and saying, wait, the world isn't coming to an end. The great financial crisis made people feel like the world was coming to an end. COVID made people feel like the world was coming to an end. This was COVID. Isn't that adorable? Look at that. That little blip right there.
Yeah, it felt like the end of the world.
It felt like the end of the world. But remember, the world is not going to zero. Stock market's not going to zero. You might sit there and say, yeah, but Paul, I have these companies, they could go to zero. Sure, they're more likely to go to zero in the stock market. But if you do your proper research and buy good companies, then as they go lower, you should want to buy more. And that's what we're trying to teach. Use a stock market crash as your opportunity. Don't wait for things to calm down. By then, if things have calmed down, you've missed the best times to buy. Pick a time and a strategy to buy and go do it.
Right.
That's the important part here. And that's what we're trying to teach. Embrace a stock market crash. It is more likely that we have one than we did before because of the fact that we've had this recent run up that's been absolutely big. I cannot stress this enough, guys. QQQ being up year to date 43% should be concerning to everyone.
Especially that we know that it was 7 stocks responsible for the majority of the
yes.
rally. You're looking at a group of basically NASDAQ 100 stocks, and 7 are holding them up.
Yeah.
That's crazy.
That is absolutely nuts. So, guys, if you like this, I encourage you, follow our channel. We will be the voice of reason for you if and when stocks fall. We'll be the ones saying this is a great time to buy. Go look at our past videos last year when we were embracing stocks falling. Embracing it. And now, do we seem like we're a fool? Sure. But I look at this going, this is euphoria. AI is euphoria. It's just an excuse to buy. It's a story that is a great story that has a lot of potential, but people are overpaying for that.
Yeah, it is a story because not much is outside of ChatGPT and some of these other open source, not much has happened. It's really just all talk at this point.
A lot of talk.
Yeah.
A lot of talk. All right, guys, thanks very much. Please subscribe to the channel and please forward this on to somebody you know that might find some use from this. I appreciate your time.